or losing you money. And once you get into that position, you need to know how long does it normally take for me to get to the target that I'm aiming for conceptually, right? And so we're going to get into that once we go through the foundational mechanics of the price delivery algorithm, as you guys can see probably on this screen here in front of us. So trading time frames report, duration, and pip target analysis. Foundational mechanics here are the core premise of institutional price action is that the marketplace is not a product of simple supply and demand. Price is delivered by an automated computer-based price engine known as the interbank price delivery algorithm, or the algo for short. This AI is programmed to facilitate market efficiency and deliver price to specific liquidity pools or inefficiencies. Excuse me. Price delivery is governed by four distinct states of delivery, and that cycle through the marketplace. And we all know what they are, which is consolidation, which is a state where price moves within a clear range as the algorithm allows orders to build up on both sides of the market. Then expansion, a price swing indicating displacement by smart money. This is where the algorithm reveals its intended repricing model by moving quickly from a level of equilibrium. And then retracement, when price moves back inside a recently created price range to retrade levels that were not efficiently delivered or fair value. Reversal is when the algorithm runs a level of stops and shifts direction to unfold a significant move in the opposite direction. And then there's consolidation once again. So it's a cycle that it repeats over and over and over again. This system operates on a time first principle. So technical setups only function if the algorithm is spooling at specific programmed intervals. So key 30-minute intervals include 7 to 7:30, 8 to 8:30, 9 to 9:30. If the time is not right, the technical setup or PD array will fail. Okay. Next, we have market efficiency. Framing the trading styles. Effective trading requires a paradigm shift from the uninformed money retail trader perspective to the smart money institutional trading perspective. Uninformed money is lured by lagging indicators and smooth retail patterns, while smart money utilizes premium or discount arrays to identify targets. Institutional analysis focuses on the draw on liquidity. The algorithm is drawn to smooth locations, relative equal highs or relative equal lows, as these represent clean pools of stop loss orders, and conversely, rough or jagged price action indicates the damage was done, so serving as proof that a stop run has already occurred. Institutional systems architect execution across the following time frames. 1 minute and 15 seconds. This is for like very precise orders. I don't know why they said this is what institutional, because institutions don't do this. It messed up. So institutions do not do this. They only operate on the monthly, weekly, daily, and they might put their trades in on a 4-hour chart. Anything like this is us doing using the institutional system. So we'll do that monthly, weekly, daily in the beginning to get like the overall trend, buyers, what the market's doing. And then afterwards, we'll use the daily 1 hour, 15, 5-minute, 1 or 15-second chart in order to like get in on really tight, really good positions that we wouldn't be able to see on those larger time frames. So that's something to take into account there. So let's take a moment. Let's see, is this it? No. Oh yeah, whatever. So oh yeah, they're doing a thing today. Okay, so I can't show you guys that market. Let me see. I might have another one. Show you NVDA. There we go. Boom. So I don't normally trade stocks or anything, but this was the trade that Truth was supposed to get for what she was trying to trade here, NVIDIA Corporation, or whatever. So as we can see here, we see gaps, we see a bit of expansion up, and then we see, I guess you can consider this to be an expansion down because it was up here and now it's way down here. So I would consider that an expansion downwards. It broke this level right here, but this is also a gap. Then it went up, retraced. If you would draw your fit from the top to the bottom of the body of the stuff that's happening, and it went to the 705. And then if you wanted a full, I would never go that far. I would have ended the trade there because that's what I would have done. But if you did go down to here, you would have still made profit. And that's the Fibonacci retracement tool. Once again, we'll go over this in another one, like the tools and stuff, like getting these numbers correct. But ultimately, this is what it's supposed to be looking like on the 15th. So if we go to the 1 month, see this close. All right, so we can see that this is clearly an uptrend. Anyone that says that it's not an uptrend is smoking, and so you shouldn't listen to that person.
That's a downtrend.
Yes. So, like I just said, if anyone says that this is anything other than an uptrend, then they are smoking. Now, what he might mean is that it looks like the next day that it does do a trade, which is going to be here, is going to go down more, and that's fair. There's a bit of liquidity inside of this area on a monthly anyway, so it makes sense. I ain't mad at that. Let's see here. Weekly chart. Once again, looks like it went up for a bit, and I'm gonna be honest. I am expecting it to come down to a range. I don't know if that's the range. The range looks like it's gonna be up here. There we go. Yeah, that looks like it makes more sense. It's right here. There's fair value gap is what we would call it. 3 candle um, pattern, I guess you could say. Just one here, one there, and wherever the wicks don't touch in the middle is typically like liquidity sitting. So liquidity is sitting on this 6.2 as well as this 7.05. What are you saying?
Oh, that's not.
Okay. Awesome. So that's that one there. Then you go down again to the daily, and this is like what their charts would look like. This is what they're looking at, saying, what are we doing here, and then where are we going? So I'm gonna be honest, it could be a reversal happening at this particular point, because as you can see, it expanded up to this point, it broke this high around over here, and then it went up, and it's been doing this thing in that range. So this was the high at that point, and then it came down to a low at this point. And technically, we could say that low is right here. And you could say it manipulated outside of the range to grab the stop losses that would have been in this area. But
that looks pretty manipulated, especially that. What are the when it doesn't have a candle, it's just invisible. What is that called? When it just like either shoots down or shoots up?
A gap. New day opening gap or new week opening gap, stuff of that nature.
Oh, okay. I didn't know it was called.
Yeah, it's a gap, and it acts as a draw on liquidity moving forward. So, anyways, on this daily chart here, the bottom right there, it looks like it broke right outside of this range. That's right. That's what it looks like. But if we paid attention, we could actually see that it didn't really do that. It just created an equal low. So this is like you would take a tool over here on the side, get a line. There's my lines. Alright, so you can get a line, and you would draw your line from here all the way across. Why are you drawing this line here? Because this is where money is formulating. Money is there. This is where all the stop losses are for everybody that's going up. So if a person wanted to do a trade going up on this, it would be difficult. I ain't gonna hold you, but let's say you did anyway.
Talking about Truth did take that trade, I think, actually.
No, she didn't. Truth didn't take this trade, unfortunately. We haven't even gotten to the part where the trade would be taken unless you're like a long-term trader. But either way, this is on the daily. This means back in September 2025, we've been in this bit of a range since then. It broke below. It didn't break below the range. It just dipped below the range, and it went up here, and now it's selling off. And honestly, I wouldn't be surprised if this starts selling off below this range here. There's a lot of inefficiencies, but that's normally a lot of inefficiencies that we're seeing in the markets regardless. And that's strange to me, but it is what it is. We go down another one. We're just doing a quick top-down analysis so we guys can kind of sort of get it. We saw that it was in consolidation. Then we see that it is looking to manipulate out of this consolidation range, which it looks like it did right here. Boom. It went out of it, and now it's looking like it's displacing in the opposite direction, which is exactly what we wanted to do. Now that you see this, the question is, okay, what do I do now, right? Like, what do I do at this particular point? Do I enter a trade now? And if I do enter a trade, how am I going to do that? Or whatever. I see this here, and then on top of that, how long am I expecting this trade to go on for? So I'm gonna give you guys like some simple, like I guess you could say like a rule of thumb. It's not like it's not a fact, but you can definitely use it as like a reference point, and that's what I want you to think of it in your head. So it's going to take about 24 candles for a trade to play out the way that you're thinking it should play out. Typically, 24 candles. So let's see. Grab our ruler over here. And let's say from the bottom to this, to the tippy top to that, this happened in 38 candles. So that's here, the bottom.
What? This is 4 hour?
Yeah, this is on a 4 hour. So
Bro,
38
that's a
candles.
lot of profit, bro. Wow.
Well,
That's
it
like,
depends.
isn't that like 3 days worth of profit?
So it would greatly depend. Four times 38 candles is 152 hours. That's much longer than just a few days. That's like a week worth of time. So that's what you would be looking to happen if you looked at a trade setup on a 4 hour chart and you did 24 candles into the future or whatever the case may have you. How much time would that end up being? In this situation, it was about 38 candles. So it's not exactly 24, but honestly, around 24, if you're not seeing progress, like after 24 candles, like from here to wherever 24 would be, which is probably around here, it went up. So you're good. At this point, you should have removed your stop loss from being outside of profit to being somewhere in profit. And you should have gotten up to this particular point. If you had a trail, it probably would have put you in to a trail right here, and it would have popped you out of that trade at this point. You would have made literally profit from here up to about here, which is not bad if you ask me. But yeah, that's how that works in that one. Over. All right, so pretty much that is what we do. So once again, yeah, so that's pretty much the way that it works. Everyone understands like the four methods or whatever the process is there. And then when you're looking at a chart and you see a setup, that's kind of sort of how they look. Institutions do it from a higher time frame, and then they get all the way down to or they let the algorithm handle the lower time frames when it's doing its thing behind the scenes. Now, another thing too that I also take into account is okay, sorry. Another thing that I take into account is when I'm looking at trades is how long do I want to be in that trade for? And if I'm not looking to be in that trade longer than the day, which I never really am, like sometimes I do take trades that last a few days, but normally it's just that day, if anything. Oh my gosh. I do apologize. You guys can't see this, but my screen is blinking on and off, and I don't like it. Make me feel uncomfortable. But it's okay. um, yeah. So for the most part, that is the general process of how how it works with the market, and we haven't really gotten completely into the time, but typically you're going to think about 24 candlesticks, which if it's an hourly chart, that's a full day. Anything under an hourly chart, you're looking at less than a day because you know it's kind of sort of how that works. If it was a 2 hour chart, any hour chart, 24 candlesticks of that chart is where you would be looking for that trade to either show you that you are right or wrong. If you are in 24 candlesticks and ain't nothing happening, you need to hop on up out of that trade as soon as possible, like ASAP.
Where's truth that she need to hear this stuff, man?
I mean, well, we'll have it recorded, so she should be able to take a look at it once I figure out how I'm gonna put that up on the internet somewhere. But either way, that's kind of sort of how that works out. So this is, super simple stuff. It's not really that difficult. I wasn't intending for it to be difficult, but I am definitely, letting you know that information there. We're going to take like a short intermission, about 5 minutes or so. And then from that short intermission, we're going to go into the rest of the setup building for everything. So before we do that, I do want to give you guys an opportunity to engage or whatever the case we're having. Does anybody know what the 4 states of delivery are?
I do not.
Okay, okay, okay. Okay. Anyone else? No one else? Fantastic, fantastic. So I'm gonna just repeat them again. There's consolidation, which is where everything tends to start. This is equilibrium of a PD array. It's at the 50% line of a PD array. So if your market's consolidating, it's in a PD array. You need to figure out what that is so that way you know what you're going to be doing. Once price goes below that 50 line, you're looking for a buy. If it goes above that 50 line, you're looking for a sell. That's just the way it normally is. And if you do anything other than, you will most likely lose money or only make a little bit of money. So, don't be that guy. After consolidation, we see some expansion. What is expansion? After it's done doing those little stop runs and stuff like that, or whatever the case may have you, it starts to move or displace. And displacing means that it moves so significantly that it created a fair value gap area. When it creates this fair value gap area, that's a target because price is going to be drawn back to these areas of inefficiency. Why? Because it likes to be efficient. It likes to allow traders the opportunity to buy and sell at any price that they want to from wherever price is going. Sometimes it gets too far away from you, but ultimately, that's kind of sort of how that operates in that range. When it's expanding, after expansion is retracement. This is when the price is coming back to that place that it just made when it displaced during the expansion, and it's eating that area up, the liquidity that was left there, the inefficiencies that were in the market, the place where it did not have an opportunity to trade in the other direction because it moved so quickly. The market allows it time to do that. And then once it's done retracing and going beyond to different points, it's going to eventually reverse. Now, where does it reverse at? Believe it or not, it's actually that one that we saw on the chart that I was showing you guys earlier. This one line. We're gonna go down to a 15 minute quick so you guys can see that. So this is typically where the retracement would happen. It's like somewhere around here. So you go ahead, draw your fib or whatever, typically from like right here down to see where it's going next, type of concept. Because it looks like, I'm not gonna hold you, it hasn't solidified it yet. This is just the first indication of a trade, going through, or getting ready. But once this line is broken and it closes below over here, from a technical analysis standpoint, that's important. I want everybody to remember this is from a technical analysis standpoint. And I'm saying this like this because typically I'm trading in the foreign exchange market, so currencies, and I don't think about this because, I'm trading those and this is how those work. But actual stocks or assets that you have to purchase from like a share based or whatever the case may have you. In that situation, that's a little different. Like those markets are, they need to have a certain level of liquidity and institutional, activity in order for that market to be usable with the technical analysis techniques for the inner circle trader. It's what it's called. So in that situation, this is just one way. It can happen multiple different ways. You can understand it however you like to understand it, but in order to use this one, we do need liquidity and the banks to be in the market doing a trade or whatever. But the reversing portion, like as we can see, it expanded. It was consolidating over here inside of a range. Then it expanded. Actually, it kind of broke down, grabbed liquidity, and then broke up, expanded up. It created pockets here or whatever the case may have you, and even up here, same thing. Or whatever. So you would imagine that price is going to come back to these areas of inefficiency, which it did. It actually did. It did come down here, and this would be the perfect place, in my opinion, to start looking for a trade going up or whatever the case may have you. But at the same time, if it breaks this here, this is where your stop loss would be in this range, about like right around here is where you put your stop loss. And the reason why is because if it breaks past this point, it might mean that the market is now looking to trade in a different direction. So if it's looking to trade in a different direction, then you just readjust, and this should be the only trade that you lose because the rest of the trade should be going in a different direction. But this is where when we looked at these, 1 month, 1 week, 1 day, 4 hour, whatever, and we saw the market doing a heavy push upwards, that's a strong bull trend. But in any trend, it's going to go in both directions. So it's most likely going to go down and then go up if it's going to, follow along with any of those rules that have been followed from before. This is for people that would do turtle soup. This like one candle wick that does down like this and then starts coming up. If it's going up, I do think it would still go up, but who knows? It's May. A lot of things like to drop down in May. So we'll see what ends up happening at that particular point. But ultimately, this is just what the market is showing us. It's showing us what it looks like it might do next, or whatever the case may have, and we're going from there. Also, you would most likely have your stop loss somewhere up here in the very beginning. When you're doing your trade, it wouldn't be that close down until like maybe you got to like here. Once the price got to this point, then you can start moving your stop loss closer down or whatever. And then once it hits this point, you should be in profit. Like literally, you should not have a stop loss anymore at that point. Your stop loss should be gone because it's past this zero mark. You should never lose $1 after it passes the zero mark. And sometimes if you do break even, you have to do a little bit further in because there are fees that you end up having to pay sometimes. So just keep those things in mind. So yeah, so that's that for right now. So what we're gonna do is we're gonna take a short 5-minute break, and we'll be right back. So come back around 11:30 Central Standard Time, and we'll continue from there.